Taxes in retirement can be a little bit confusing, and this is because you have multiple income streams or taxable events that need to coordinate together. Capital gains specifically can be quite confusing for this exact reason. How it coordinates with your other assets can lead to some confusion and thus mistakes. I'm going to talk about 3 common capital gain mistakes that I see on an ongoing basis and show you how to fix them. But before diving into these mistakes, it's first important to understand how your income stacks in the eyes of the IRS. This will offer a lot of clarity as you're taking some of these mistakes and applying them to your situation. So it's important to understand that your ordinary income stacks on first. That's the foundation. And so what's included in this would be forced income, whether that's pension income, annuity income, or Social Security. This is your guaranteed income that stacks within that foundation. Next, your tax-deferred withdrawals stack on top of that. Again, those are taxed at ordinary income rates. Next, you have capital gains that stack on top of that. So it's very important to understand as you have a base level of capital gains and you start filling in with additional IRA withdrawals, that will push up where your capital gains are taxed. This will come back in one of the mistakes that we talk about. And then finally, your Roth withdrawals stack on last. Those are obviously tax-free. So mistake number 1 is leaving bracket space during conversions. And so let's say that we have 2 separate taxable events that we need to consider here. So we have a married couple and they took $110,000 of IRA withdrawals throughout this year, and they have long-term capital gains of $30,000 that they need to be considering here. Now, they ultimately want to max out the 22% bracket here in 2022. Now, as you can see on the right-hand side of the screen, they can bring their income all the way up to $178,150 of taxable income and still be within that 22% bracket. Now, on the bottom half of the right-hand side of the screen, you'll see that capital gains tax above $83,350 is taxed at 15%. Now, a mistake that I see a lot of retirees make is they take their gross income, which would be $110,000 plus $30,000, and they use that to gauge where they can max out that 22% bracket. And if we think about this doesn't exactly make sense because remember, capital gains stack on last. The 22% bracket is applied to ordinary income rates. And so they can take their ordinary income all the way up to $178,150. They can push their capital gains above that because as we see on the screen, that's still only going to be taxed at 15%. And so, for instance, let's say they calculate their room to convert as they take the $178,150 mark, that top of the 22% bracket. They subtract out their gross income right now and then add in the standard deduction because, again, that will be another subtraction there. And they see that they have $64,050 left to convert within the 22% bracket. This is the wrong way to calculate how much room they have to convert. The right way to calculate out how much room they actually have to convert is leave out their long-term capital gains. Because again, they will be able to max out the 22% bracket and still have that tax at 15%. And so now what they should do is they should take that $178,150 target. They should minus out or subtract out that $110,000 of IRA withdrawals and then calculate on top of that, adding in the standard deduction. And what they would find is they actually have $94,050 of room to convert. So about $30,000 more than they originally calculated. So it's extremely important to make sure you're calculating out the coordination between ordinary income and capital gains when we're laying out how much we can actually convert in a given year. We want to make sure we get as much as we can out of that given conversion if we're maxing out that 22% bracket. Mistake number 2 that I see is not accurately calculating in the net investment income tax. And this is generally an issue I see a lot when people are performing a large conversion or string of large conversions for a couple of years, and they also have capital gains that they need to be calculating in as well. So what is the net investment income tax? Well, this is essentially an added surtax that's related to the Affordable Care Act with once you show over $200,000 of AGI as a single filer and $250,000 of AGI as a married filer, you will have an added 3.8% surtax on your capital gains. Now, it's important to note this is not a tax cliff. It's just what capital gains are pushed above that $250,000 mark if you're a married filer and $200,000 if you're a single filer. And let's look at why it's important to make sure that we're calculating this in. So let's take a situation, once again, we're using a married filer and they have $130,000 of IRA withdrawals and they happen to have a very large long-term capital gain bill because of selling certain capital assets. And so they have $100,000 worth of long-term capital gains this year. Well, let's say that this couple is willing to max out the 22% bracket, but they don't want to go above a marginal rate of 24%. Well, what happens when we have this large capital gains tax bill, whether this happens within the 22% bracket or whether this happens in the 24% bracket, we need to understand that once we start passing that $250,000 of AGI, now our capital gains will move up and have an added 3.8% surtax. We can see here that if they maxed out the 22% bracket with a Roth conversion, and that would be about $74,000, we would see that about $50,000 of that conversion would actually have a marginal rate above 24%, which remember, we don't want to push our marginal rate above that zone for this specific situation. We can see that they really only have about $20,000 worth of room to convert if they want to avoid that net investment income tax altogether. And so this is a common issue that I see and one that you absolutely need to be factoring in if you're performing fairly large conversions for a stretch in your retirement. Keeping in mind that as you push yourself into that 24% bracket, or if you have a very large capital gains bill, even if you're pushing yourself to the top of the 22% bracket, you may be subject to that 3.8% surtax. And then finally, mistake number 3 is misunderstanding how capital losses work inside of your tax formula. And so on the screen, we have a married couple that's trying to avoid IRMA. Now, the IRMA threshold they're trying to avoid is $182,000 of modified adjusted gross income. And so they don't get to take out the standard deduction. It's important to note that IRMA is a tax cliff, so they want to make sure they don't go even a dollar or a cent over that given tax cliff. Now, on the screen, we have IRA withdrawals of $100,000. We have dividend income of $20,000. So they obviously have a taxable account that's releasing a certain level of dividends that we need to be factoring in here. Then they happen to have capital losses here in 2022 because of market activity of $20,000. And so how much room does this person have to convert before crossing over IRMA? I have two answers here. Do they have $82,000 of room, or do they have $65,000 worth of room? A lot of you might be thinking they have $82,000 worth of room, because if we take their IRA withdrawals, that's $100,000. We have dividend income, which we need to be adding in, but then we have capital losses, and don't those cancel out? If they don't, however, we only have $65,000. Now, why $65,000? That might be a little bit confusing. Well, let me show you the math. And in this specific situation, they do only have $65,000 of room. And the reason for this is that capital losses cannot offset dividend income. Now, this is oftentimes confused because dividend income is taxed, if qualified dividends, at long-term capital gains rates. We know that capital losses can offset capital gains. So shouldn't they offset dividend income as well? And unfortunately, the answer is no. Dividend income cannot be offset by capital losses. And so if we go through the math for how much room they have to convert, we see that they have $100,000 of IRA income. Now, we can subtract out $3,000 of those capital losses because you're allowed to offset $3,000 from your income when you have those capital losses on an annual basis. We then have to add in the $20,000 of dividend income. If we subtract out that IRMA threshold, we find that we have $65,000 of conversion room. And so you need to absolutely be making sure that if you have capital losses, you're adequately offsetting properly within the capital gain formula. Again, capital losses cannot offset dividend income, but they can offset capital gains, whether that's short-term or long-term. And so understanding this is very important to making sure that we avoid critical tax cliffs like IRMA. And speaking of capital gain offsetting, this can be yet again another confusing part of calculating out your tax bill properly. For instance, we know that there is offsetting when it comes to capital gains, but how does this offsetting work? Do long-term capital losses offset long-term capital gains or short-term capital gains? Do short-term losses offset long-term gains or short-term gains? And how do these all work together? This can be quite confusing for a lot of retirees. Well, in this video right here, I have recorded what is a simple framework for understanding this capital gain offsetting. I call it the capital gain matrix. You can click on this video right here and learn a little bit more. Thanks for watching, and always remember, you don't need more money, you need a better plan.